And earnings are what determine value, not book value. Book value is not a factor we consider. Future earnings are a factor we consider. And
we've tried to put in the annual report pretty much how we approach securities, and book value is not a consideration, virtually not a consideration at all.
Book value is the value of a firm's assets, fewer impairment costs, amortization, or depreciation costs made against the investment. Book value is crucial for the company's ability to attract stakeholders. Warren Buffett, a successful entrepreneur, doesn't see it as a necessary factor to analyze stock. In this video, we will look at some of the reasons why.
The best businesses, by definition, are going to be businesses that earn very high returns on capital employed over time. So by nature, if we want to own good businesses, we're going to own things that have relatively little capital employed compared to our purchase price. That would not have been Ben Graham's approach. But Ben was not working with very large sums of money, and he would not have argued with this approach. He just would have said his was easier. And it is easier, perhaps, when you're working with small amounts of money. My friend Walter Schloss has hewed much more toward the kind of securities that Ben would have selected, but he's worked with smaller amounts of money. He has an absolutely sensational record, and it's not surprising to me at all. I mean, when Walter left Graham, though, I would have expected him to do well, but
Warren Buffett differs from Ben Graham's approach, as emphasizes how capital is crucial for a firm's success. He scrutinizes the risk involving considering the purchase price and gives investors a hint not to underestimate the power of money they have. Intrinsically, this is sensible because why purchase a substandard firm at a high cost while the little money you have can do wonders? He alarms investors that it is less risky to invest with money and more costly to go for the purchase price.
I don't look at the primary message from our standpoint of Graham really as being in anything to do with formulas. In other words, there's three important aspects to it. One is your attitude toward the stock market. That's covered in Chapter 8 of The Intelligent Investor. I mean, if you've got that attitude toward the market, you start ahead of 99% of all people who are operating in the market, so you have an enormous advantage. Second principle is the margin of safety, which again gives you an enormous edge and actually has applicability far beyond just the investment world. And then the third is just looking at stocks as businesses, which gives you an entirely different view than most people that are in the market. And with those three sort of philosophical benchmarks, the exact evaluation technique you use is not really that important, because you're not going to go way off the track, whether you use Walter's approach or Walter Schloss's or mine or whatever. Phil Carre has a slightly different approach, but it's got those three cornerstones to it, I will guarantee, and believe me, he's done very well. Charlie?
Warren Buffett looks at Graham's perspective in an elevated way. He adds that the attitude towards the stock market is essential. For example, risky attitudes clarify the puzzle the stock market participation. Similarly, portfolio theory foresees stakeholders who are less risk-averse will have greater shares of risky assets such as stock. Furthermore, the margin of safety is vital because you don't want to invest in a business where you will lose money. Generally, the ultimate goal of an investor is to minimize loss and maximize profits. Hence, margin of safety is crucial. Moreover, a stock business is essential as Warren Buffett validates how the nature of the company can have future repercussions. For example, if a scope of a company is based on fraud, would you consider investing there?
Yeah, to the extent that the method of estimating future cash flow requires projections, I would say that projections, while they're logically required by the circumstances, on average do more harm than good in America. Most of them are put together by people who have an interest in a particular outcome, and the subconscious bias that goes into the process and its apparent precision makes it it's fatuous or dishonorable or foolish or what have you. Mark Twain used to say, a mine is a hole in the ground owned by a liar. And a projection prepared in America by anybody with a commission or an executive trying to justify a particular course of action will frequently be a lie. It's not a deliberate lie in most cases. The man has gotten to believe it himself, and that's the worst kind. So I don't think projections are to be handled with great care, particularly when somebody has an interest in misleading you.
Berkshire Hathaway Vice Chairman Charlie Munger smartly overviews the book value from the perspective of individuals who want to exploit the investor by giving false information for their gain. He warns investors of greedy individuals who are cunning by overvaluing their businesses to escape a marred financial past. He propagates the need for fair valuation and realistic projections as business ethics and professionalism. He urges investors to keep track of a company's history, as companies are famous for bootstrapping value to justify their worth.
And earnings are what determine value, not book value. Book value is not a factor we consider. Future earnings are a factor we consider, and as we mentioned earlier this morning, earnings have been poor for a great many Japanese companies. Now, if you think that the return on equity of Japanese business is going to increase dramatically, then you're going to make a lot of money. I mean, and you're correct, you're going to make a lot of money in Japanese stocks, but the return on equity for Japanese businesses has been quite low, and that makes a low price to book ratio very, very appropriate, because earnings are measured against book. And if a company's earning 5% on book value, I don't want to buy it at book value if I think it's going to keep earning 5% on book value. So a low price book ratio means nothing to us. It does not intrigue us. In fact, if anything, we are less likely to look at something that sells at a low relationship to book than something that sells at a high relationship to book, because the chances are we're looking at a poor business in the first case and a good business in the second case.
Warren Buffett emphasizes how a firm's future is essential when choosing an investment decision. We know Warren Buffett always looks at the future permanency of the firm. His success has been built on long-term investment, and investors should learn not to be blinded by short-term prospects. Short-term valuation carries a lot of future consequences. For example, what is the of investing in a company only to get $500 million of profit in 1 year, and then the impossible happens when the company is slapped with a loss of $600 million in the next 20 years? Quite stressful, right? I hope you have learned something new today. Please hit the like button and don't forget to subscribe. Let us know your view in the comments section.